Continue our look at the housing market. Karen Weaver is the global head of securitization research for Deutsche Bank Securities, and she says we haven't even hit bottom yet. She joins us here in studio. Welcome to the show. Thank you so much. Let's start with why you think we haven't hit bottom yet, because we seem to have some signs of turnaround. You see the Case-Shiller price numbers inching up month over month. The labor picture is starting to look a little bit better. Credit maybe not quite as tight. What do you see that points to a continued decline?
Well, unfortunately, there's still a number of negative fundamentals that are impacting the market, and they vary a lot by market, so it's hard to say a U.S.-wide picture. But, for example, the biggest problem we have, and as your former guest was talking about, is the foreclosure problem, the people being underwater. And that problem is really hitting the sand states, if you will, California, Florida, Nevada, Arizona. In other parts of the country, where we are right now in New York, the problem is home prices are still much too high relative to fundamentals, so we really haven't corrected. If you look at income, if you look at mortgage payments, affordability in New York is still way off of sort of the historic norms.
You were saying, actually, we were talking earlier, back in 1998, a home in New York cost, what, 4 times the average income?
About 4 times the median income to buy the median price. And the average in New York had been somewhere between 4 and 5, sort of pre-bubble. And now, even with prices having come down quite a bit in New York, somewhere on the order of 22%, we're still at 7 times income for New York.
That is unbelievable. 7 times what the average person earns in a year is what it costs to buy the average home. And as you mentioned to me before, Wall Street bonuses are not bad this year again. Does that point out to you that we're going to see a continued rise, or?
Well, it's going to be very interesting to see how spring plays out in the New York market, because as a practical matter, it has been a good year for Wall Street, and that not only directly impacts but has the spillover impacts. And a lot of people might be saying, well, you know, this can be an opportunity. It's still a lot lower than it had been a few years ago, even though fundamentally we think it could go further. And I guess if you're looking at a place to put your money, you're not going to get anything if you put it in the bank, and the stock market has run up quite a bit. So we might be a little surprised by the spring, but eventually I think the market has to capitulate with the fact that we're just quite out of line in terms of the relationship between income and home prices.
It just can't be sustainable.
I don't think so, not in New York. I mean, we're not going to be as cheap as other parts of the country. We never have been. We're not going to be 2.5 times income, but 7 times seems a bit vulnerable in the scheme of things.
All right, let's get back to the foreclosure problem. A lot of talk today. There's been a lot of talk for a while, but especially today, about cutting principal on loans. Do you think that that's inevitably what we're going to have to see banks do to deal with this problem?
I think at the end of the day, we'll see more of it, because the government's attempt through modifications and the schemes and paradigms that have been in place, I think anyone has to conclude have been a failure. We have something like 7 million borrowers delinquent. We have 31,000 people who have received a modification under these government programs. Now, there's a lot of people still in trial, but it's woefully inadequate. So I think we may get to that as we progress through this crisis. The problem, though, is that we haven't talked about where that's going to be born. It sounds great to say, well, let's reduce somebody's mortgage, let's give them an incentive, give them some equity so that they pay. And, of course, that will be pretty successful, as you might imagine. If somebody goes from being underwater by $50,000 to having $25,000 worth of equity, they're going to pay.
But negative equity is, I mean, look at this chart, which we just took away here, but you know it well because those are your forecasts. Negative equity is the problem here, isn't it? I mean, it's the biggest determinant of whether someone's going to default on his or her mortgage. Sure. And you're forecasting that we see 42% of homes underwater on their mortgages by the end of this year.
42% of borrowers, and not everybody with a home has a mortgage, but 42% of mortgage borrowers under our forecast. So the issue is that, yes, if you wipe away that negative equity for all those borrowers, you will certainly get better performance out of those mortgages. But where is that money going to come from? Is that borne by the financial system? Is the government going to step in for that? It's a very expensive proposition to just say, let's rewrite all these mortgages. And I think one of the issues we have in terms of implementing it is fairness. You know, part of the underpinning of capitalism and democracy is some sort of fairness and rules of the road. And if you disturb that, then you'll have all 21 million people, whether they need it or not.
You do think, though, inevitably the government comes out with some major push here to help stop foreclosures?
I don't think we've seen the last of government policy trying to address this, because they're still increasing. The rate of mortgages becoming delinquent is increasing, and then we know we're going to continue to have more foreclosures. This is not the end of this crisis by any means, and I think that politically it's going to become increasingly difficult to not have addressed it in some way.
All right, Karen, thank you so much for spending some time with us today.
Sure.
Deutsche Bank's Karen Weaver. Carol